Now we will learn why learning accounting is important for non-finance professionals, as well as we will learn who are the stakeholders of a business who have an interest of the accounts and financing of the business. Now, why accounting is important for non-financial professionals, other professionals? Now, accounting being record keeping, it records all the financial transactions. So, if a professional knows accounting, right, if he understands accounting, he will be able to acquire financial skills such as financial discipline, where you record all the transactions so you can monitor your expenditure, things like that. Monitor expenditure, understand the financial position, and also account being aware of accounting, you will be able to identify the profitability of a business, because all businesses exist to create profits, add value to the business, add value to the owners. So accounting will calculate the profitability of a business. So any other professional, if you are in sales, if you are in, let's say, operations, still accounting will be helpful for you, because accounting will help you to calculate profitability. And also accounting is a numbers game. So if you know accounting, you will know the numbers. So frauds, errors can be prevented, and you will be able to understand everything in and out of the business from the numbers of the business. And also you will be able to understand the financial statements of the business, the income statement, statement of financial position. You will be able to identify, you will be able to understand the accounts of a business, uh, accounts of a bank, accounts of an insurance company, accounts of a hotel. You will be able to understand. And also any professional, if they know accounting, that will be useful for them for financial record keeping, develop financial skills, financial discipline, identify the profitability of a business, understand and interpret the numbers, and understand the financial statements of any business. Those are the importance of accounting for other professionals. Good. Now we will move on to some more areas. We will try to understand who are the users of financial statements, who are the users of accounting. For that, we will try to develop and understand the concept of stakeholders. Stakeholders are the parties who try to understand, who try to read, who try to use the financial statements and accounts. So we will develop that particular argument, develop that particular study area through a question, student question. Look at the slide. Which stakeholder groups do you think would be interested in accounting information, and why? Which stakeholder groups do you think would be interested in accounting information, and why? Now, if you can remember, if you go back to our very first definition, what is accounting? If you can remember, accounting is a process of financial record keeping, analyzing, and everything for the purpose of decision making by the users of accounts. They are the stakeholders. Now, stakeholders are the ones who will use the financial statements in order to make decisions. Who will use financial statements in order to make decisions. Who are stakeholders? Stakeholders are the individuals, the companies, and the parties who have an interest on the affairs of a business. Stakeholders are the parties, individuals, and companies who have an interest on a company or a business. These parties have an interest on the business and how the business performs and operate. Now, if you take a shareholder of a company, a shareholder owner of a company is a stakeholder of that particular company. They have a stake, they have an interest on the affairs of the company. They have a stake and they have an interest on the affairs of the company. So stakeholders use accounting, the financial record keeping, to make decisions on the business, on the company. Like shareholders use accounts, financial statements to make decisions on that particular business. So, stakeholders, once again I'm repeating, are the parties, individuals who have an interest on the business. So, the first type of the stakeholder of any company, any business are the shareholders or the investors. Investors and shareholders have a high degree of interest, a stake in the business, because they want to know how much amount of profits, how much amount of return on investment that the business has generated, and what's the financial position, because they want to know whether their money is properly being utilized by the business. So shareholders or investors are a stakeholder, and they want to know the return and the risk of the investment, and also for buying, selling, and that particular decision making. They want information from accounting. Okay, so another stakeholder, another party, another group of individuals who have an interest on the affairs of the business. Employees, the workers. Employees of the business also have a stake on the business. They also have an interest on the business, because employees want to know whether their jobs are adequately secured, and whether the salaries, the bonuses, allowances that are paid to them are adequate or enough, and stability of the business. So for that, employees need the accounting, they need the financial statements, and also employees need the accounts and financial statements for wage bargaining, bargaining of salaries, salary bargaining for that activity. So employees, another group of stakeholders who have an interest on the business, and they will also use financial statements for their own purposes. Another stakeholder group, another set of individuals who have an interest on the business. That's the management of the business. The management. That means the board of directors, the CEO, the senior management of the business, the directors, they also have an interest on the business, have a stake on the business. And also they want accounting, financial record keeping for their purpose as well, to see whether the performance of the business are in line with the decisions that they have taken, and whether accounts will tell them whether the business is achieving the targets, whether the business is achieving its objectives. Accounts will tell that. So next group, managers and directors, they also need accounting for their decision making of performance evaluation, target setting, things like that. Another set of stakeholder group, the lenders, the banks, and the providers of debt capital. The banks and lenders wants to see whether the financial statements of the business provides adequate profitability, adequate gearing for the business to pay off their debts, to pay off their amounts lent to the company, whether the business can pay the principal and interest on time. Those will be shown to the stakeholder group lenders by the financial statements and accounts. So lenders and providers of debt capital are also a part of the stakeholder group. Next, suppliers and trade creditors, like let's say vendors, suppliers, creditors of the business. They also want to know whether they also want to know from the financial statements whether the company pay off their dues. The suppliers, providers of credit, they want to know from the accounts of the business, from the accounts of their customer, to see whether the customer can pay off their dues on time. Accounts will show that. So suppliers and trade creditors are also another group of stakeholders. Then customers. Customers are also a stakeholder. They have an interest on their supplier, because customers nowadays won't buy on ad hoc basis. They want partnerships, they want relationship for a long time to purchase for a long period of time. Let's assume if you are a customer and you are buying a large quantity of items for a long period of time, you want to know whether your supply is stable enough, whether your supply is financially stable. So how do you know that? You will learn it from the accounts, because accounts, the financial statements will show you that whether your supplier can provide you the goods directly for a long period of time. So customers also are a stakeholder who will make decisions based on accounts. Then government and government agencies. Government and government agencies will also look at the financial statements. They will make decisions based on the financial statements accounts prepared by a business, like tax calculations, because taxes are calculated, computed purely on financial statements, and to obtain statistics, data on the business, and to regulate a particular sector, sometimes to provide a subsidiary or grant. For that, government also needs financial statements and accounts. Then analysts, business analyst, external analyst, they also want accounts, financial statements for evaluating performance, to provide their clients buying and selling decisions on stocks as a stock analyst. So they will use the financial statements prepared by a business. And the general public. General public want to know from accounts to put pressure on the business to do more corporate social responsibility, and to get some income for their local economic activities. All this information the general public will be obtained from the financial statement. So general public is also a party that has an interest on the business, who are a stakeholder. Now, accounting as a profession will help a business in achieving many objectives. Accounting, once again, I'm referring to the simplified word, financial record keeping. It will show the business things which are there in this particular flowchart, like how well the business has pleased their customers. It will be shown by how well the revenue profits have moved up, and how good the company is making the profits. Then how reinvestment in new and improved company assets and expand markets. Information will be given by financial statements, how to expand into new markets, and how employees are giving their best to the business, produce and sell efficiently. All these things, all these aspects will be shown to the business leaders by accounting. Now, all these business objectives will be achieved by accounting. So once again, financial accounting is the classification, recording, monetary transactions of an entity in accordance with established concepts and principles, accounting standards, and legal requirements, and their presentation by means of income statements, balance sheets, and cash flow statements during and at the end of accounting period. This is how CIMA terminology says. So just go through this particular definition, but ultimately remember, it's financial record keeping, classification, analysis of accounts for the users to make business decisions.